This is Nashimar, the CEO of InfoTaxCard.com, and we are a team of CPAs and EAs. What steps should be taken to determine if the investment is at risk? This is my today's topic, in which I am going to explain the qualified non-recourse financing, recourse debts, and non-recourse debts. Mooch Financial acquired. Mooch Financial acquired rental real estate by borrowing some money from a related bank on commercially reasonable terms, and the remaining money was borrowed from the seller. Now we have to find out what money is at risk and what is not. The loans were secured solely by the property and had no recourse. Mooch's loan from the related bank. Mooch loan from the related bank is at risk due to qualified non-recourse financing terms and non-recourse loans for real property. No matter what the terms are, Mooch will not be responsible for the seller's loan, since it is a non-recourse debt and not qualified non-recourse financing. What are the rules and regulations to determine whether the investment is at risk or not? Let me just explain the rules and the regulation before I explain it with the help of a case study. What are the rules and regulations to determine whether the investment is at risk or not? Number one, the amount of deduction over gross income that is attributed to the activity is referred to a loss. The regulations are applicable to people, associates in partnership. The regulations are applicable to people, associates in partnership, associates in limited liability company, members of S corporation, trust, states, and certain closely held C corporations. So all these characteristics are part of the amount of loss that can be deducted is limited to the amount at risk in the activity. Let me share again. Number one, the amount of deductions over gross income that is attributed to the activity is referred to as loss. Number two, the regulations are applicable to people, associates in partnership, associates in limited liability companies, members of S corporation, trust, states, and certain closely held C corporations. The rules are applied to every trade, business, or income producing activity in a distinct manner. Now we are going to learn the end of the tax year determines the level of risk associated with an activity. The initial at-risk amount for someone includes the money they contributed, the adjusted basis for the property they contributed, and borrowed amount. Recourse debt is typically factored in the amount at risk. If the borrower is personally responsible, responsible or has pledged as a security for the loan, it is considered at risk and qualifies as recourse debt. The at-risk amount excludes debt if any of the following applies. Number one, property that has been pledged as security is utilized in the activity. Number two, personal liabilities. Personal liabilities can be prevented by insurance, guarantees, stop loss agreements, or similar arrangements. Number three, the creditors. The creditors can be anyone with an interest in the activity or who is related to the taxpayer. Now we are going to learn non-recourse debt is usually not included in the amount at risk except for qualified non-recourse financing. Qualified non-recourse financing loans are considered risky and are linked to the act of owning property. Qualified non-recourse financing is not personally accountable to the taxpayer. Now we are going to learn what is included in qualified non-recourse financing. It is involved a real estate transaction. The real property is responsible for securing it. The ownership interest is not convertible, and a third party is not related to the seller or the seller's relative, but a related party can provide commercially reasonable terms of, or a governmental entity can guarantee it. We have covered in this topic what are the qualified non-recourse financing, what are the recourse financing, and what are the risk of the non-recourse and recourse financing. And we have also covered what are the rules and regulation to determine whether the investment is at risk or not. The end of the tax year determine the level of risk associated with an activity. Recourse debt is typically factored in the amount at risk. The at risk amount excludes that if any one of the following which I have explained, which I have described here. And non-recourse debt is usually not included in the amount at risk except for the qualified non-recourse financing. And what is included in qualified non-recourse financing. Thank you and God bless you.